Traditional economics assumes three things about you: that you are perfectly rational, perfectly well informed, and have full self control. You're none of these things, neither am I. And once you understand that, everything about how you invest and handle money will change. So, most people think economics is about GDP, inflation, supply and demand curves, and sure, that is right. That's part of it though. But the part that actually changed how I think about my own money is behavioral economics. So I took a course last semester about behavioral economics and learned that markets are not always efficient, that people are not always rational, and that the gap between theory and reality is where all the money mistakes happen. Today, I want to walk you through 5 things my economics degree taught me about money and how that can help you. So these 5 lessons I've learned about over the past year, I would say, and they're super important. So let's just dive straight in. So lesson 1, compound interest is the eighth wonder of the world. It's so strong that they call it the eighth wonder of the world. Let me explain why. Everyone says this, but they still underestimate it. And it's not really their fault. It's because our brains, they think linearly, not exponentially. So we can't grasp what 7% per year over 40 years looks like. It's a huge exponential curve. It's not a straight line. Um, so going into lesson 2, cash is not safe. It's being taxed by inflation. If you keep 10,000 euros in a savings account, earning 1%, while inflation runs at 3%, for example, you're losing that 2% of your purchasing power every single year by doing nothing. Holding cash feels safe, but again, economically, it's so risky over the long term. Lesson 3, you can't beat the market consistently. So this comes from something called the efficient market hypothesis. So the idea is that prices already reflect all available information. So trying to pick stocks that are undervalued for most people is a losing game. And the data actually backs this up too. Over 15-year periods, about 90% of actively managed funds, so those funds trying to beat a certain benchmark or a certain index. Okay, so these actively managed funds, they underperform their benchmark index. That means that professionals with teams of analysts and millions of dollars behind them and Bloomberg terminals, they lose to a simple index fund. So what does this mean for you? It means stop trying to pick winners and please stop trying to time the market. I have so many friends trying to do exactly that. And that's partly why I'm sharing these videos. Anyways, stop waiting for the perfect time. Just dollar cost average, DCA, which is basically buying regardless of when the market is high or low. If you keep doing that over many periods of months and years, you're going to tend to average out over the long term. So let time do the work, not you. Lesson 4, people aren't rational, and that creates real financial consequences. This is a huge one. My behavioral economics classes showed me that every financial decision you make is filtered through biases through your brain that you don't even notice. For example, loss aversion. It makes you hold losing investments too long. And status quo bias, for example, stops you from starting in the first place, which is what you're probably suffering right now, and what I suffered before, and what my friends suffer from. I'm going to go deeper in each of these biases because they're super important in future videos. But the main thing is the biggest threat to your portfolio is not the market, it's you. Lesson 5, risk is not the same as volatility. Risk does not equal volatility. So when most people see their portfolio drop 10%, they panic. But a 10% drop in a diversified index fund when you're 20 years old is not risk, it's just noise. Real risk is permanent loss of capital. Real risk is inflation eating away your savings. Real risk is not investing at all because you're scared of a number going red on your phone. Right now, most of my portfolio is red. I'll show you it. But I'm not bothered by it because I know this. So, the reality check. Here's what I see in classmates. Even the ones studying economics with me, studying the same things that I'm telling you about. They either keep their money in savings accounts because it feels safe. They check stock prices daily, even though they plan to hold 20 years. I don't know why. And that's called trading. And on this channel, I won't be talking about that. I don't agree with that philosophy, especially for those trying to build and accumulate wealth over the long term. Why do you need to check your portfolio every day? If you do so, and case in point from my friends, they're going to be trading more. And I'll tell you why later on in future videos why that's bad for those trying to accumulate over long term. And they think that picking individual stocks is a smart move because they read about Warren Buffett once. Or they do nothing at all and they say, oh yeah, I'm in my 20s, let me enjoy my time first, and then I'll start investing in my 30s. Well, compounding is not on your side in that case. So once you're fully aware of these points I made, you can begin your investment journey. Thanks. If you're smart, ambitious, and still unsure what to prioritize, this is for you. I'm opening a waitlist for Behind the Scenes Blueprint Lab, where I share the exact systems I used to juggle internships, studies, building, investing, fitness, and social life in my 20s. Tools that start from where you are, not where you should be. Join using the link in the description.